Welcome to this webinar, The Impact of Private Equity Hedge Funds on Trade Creditors' Rights. We'll get started now. Thank you all for joining us. We've got a big crowd for this webinar. I'm pleased to introduce all of you to our friends at Lowenstein Sandler, who have graciously agreed to share their expertise on this important topic. Lowenstein is a national law firm of about 300 lawyers with offices in New York, New Jersey, Washington, D.C., Utah, and California. And our old friend, Bruce Nathan, is undoubtedly one of the country's best known and most highly respected lawyers specializing in bankruptcy, financial reorganization, and creditors' rights. Also with us today is Andrew Behlmann, who will share his deep expertise in the law of corporate finance and his experience in complex Chapter 11 cases. I'm Bill Danner, President of CreditRiskMonitor. We have about 30 minutes of presentation material, and to make sure we get through it all, we'll hold questions and answers until the end of the webinar. Please don't be shy with your questions. If time doesn't permit us to get to all the questions, we'll do our best to answer you via email later this week. To ask a question at any time during the presentation, just use the webinar tool, which is located down at the bottom of the screen. So, Bruce, are you finding private equity and hedge funds are involved in more and more bankruptcies? Because it seems that way to us.
Yes, I do, and thank you. First of all, thank you, Bill, and good morning to everybody. I hope you're experiencing a lot better weather than we are experiencing here in New York and the Northeast. And yeah, bankruptcy has changed since I started practicing back in 1981. I feel like a dinosaur. And in recent years, hedge funds and private equity funds have become major players of many high-profile Chapter 11 cases, and they've become drivers of those cases. And the key creditor strategy is to be able to react to them, because their involvement has dramatically changed the strategies of debtors in terms of their exit strategies if they need to financially restructure and they file Chapter 11s. Private equity funds have had an adverse impact on trade creditor recoveries because they are sharks, and I am not saying that derogatorily, but there is a limited pie, and their goal, to put it in plain English, is to get as much of that pie for themselves as possible, even in adverse circumstances. And their control over the process, the Chapter 11 process, by virtue of some of the stuff that Andrew and I are going to be talking about, has raised a lot of concerns again about the trade creditors' ability to recover. So let's go to the next screen to talk about why. The private equity and hedge fund folks who do lending, they have very different motivations than traditional bank and asset-based lenders had, and they were the traditional lenders of the past. Private equity and hedge funds are all over the capital process, the capital structure, including as lenders. They're less regulated than commercial banks. Their management, their fee structure, their equity ownership motivates them to invest and lend into riskier portfolio companies and to have riskier capital structures. And of course, riskier capital structures means more risk for the trade creditors that are providing unsecured credit. Their goal is to upstream as much cash from their portfolio clients, your customers, as quickly as possible. And again, one of the challenges in Chapter 11 case is for a creditors committee to uncover these upstream dividending and redemptions into potential recoveries for unsecured creditors to increase your recoveries in Chapter 11 cases. Let's go to the next. Private equity sponsored companies have accounted for a larger share of bankruptcies, per recent industry reports. And I was looking at an article by FTI talking about between 2016 and late 2017, private equity-owned companies accounted for 35% of all large Chapter 11 bankruptcies, much higher than previous years, and this trend is continuing into 2018. But interesting, among retailers, that number was almost twice as high. 67% of all Chapter 11 filings by retailers in the 2016 to 17 period are from private equity-backed companies. You're continuing that trend into 2018. the bad news is this trend is going to continue. Distressed companies are likely going to need to restructure up through 2020 and even beyond, and they include a high percentage of private equity hedge fund companies. That's all part of the debt wall that's coming up. A lot of debt is coming due in the next few years, and unfortunately, we're in kind of a perfect storm because interest rates are going up. The economy, while it's riding high now, there's concerns about a recession in the next few years, and all of this is going to take its toll on private equity or hedge fund-backed companies because of the over-leveraged position that they're in. Andrew, why don't you continue to put some more flesh on this bone?
Take a look at some of the differences between a traditional company and a hedge fund portfolio company or a private equity portfolio company. Then we'll move forward and look at what the capital structure of a PE portfolio company looks like and how that's different from a traditional company. This is obviously relevant to all of you in the audience today because these are your customers, and your customer base is shifting from quote-unquote traditional companies, the old line businesses, to more and more, presumably, portfolio companies of private equity firms. So in a company, you've got a fairly simple capital structure. You'll typically have, a commercial bank as the secured lender. You'll have a Bank of America. You'll have, a big traditional name that you know, or maybe a local bank. They'll have a fairly simple debt structure. They'll usually have a single layer of secured liens. It might be bifurcated. They may have, a lien on their hard assets and a lien on their receivables and all that stuff. But it's usually a fairly simple and straightforward debt structure. Companies might be publicly traded or closely held. You have a board that's elected by shareholders whose motivation is to maximize the equity value. And as we all know, there's no value for equity until there's value for everybody else senior to equity. So that's a sort of a broader, long-term strategic goal. And businesses have a long-term focus. They focus on sustainable growth or try to focus on sustainable growth in earnings and growth in sales. So traditional businesses had to focus on the big picture, the long term, not just the next quarter, not just the next, earnings call, not just the next, 6 months to a year. And they had a fairly straightforward entity structure. If you dealt with XYZ Corporation, you knew who your customer was. You weren't necessarily dealing with, a fourth level subsidiary below XYZ Intermediate Holdco 5 or something. On the flip side of that, the hedge fund world and the private equity world, portfolio companies tend to be a little more complicated to deal with. Even a relatively small business may have several layers of holding companies involved. That would be for an assortment of reasons, for risk allocation, for risk bifurcation, for moving value, other places in the structure so that it's siloed. So in the event of a bankruptcy, for instance, at an operating company, there might be assets at a real estate holding company that, that the fund can extract value through. Sometimes, as Bruce mentioned, you've got people that are on both sides of the capital structure, both debt and equity. Now you've got a board that's being elected by shareholders that also happen to be lenders, so their motivations shift. They're no longer just, let's look at the long term. It's, hey, how do we extract some cash flow out of this thing in the short term? And ultimately, at least from a private equity standpoint, the goal is typically always, because these are usually closed-end funds, the exit. We're going to get out of this thing, and how are we going to get our money back between now and then and maximize the amount of cash that we extract from it? So it's a vastly different focus overall. Next screen, we'll take a look at the different capital structures between a traditional company and portfolio company of a hedge fund or private equity firm. So before, in a traditional company, you've got a pretty straightforward capital structure. You've got, one or two secured lenders. You may have some bondholders in a bank. You may have, an ABL that's split off with some collateral. Then below that, you've got unsecured debt, trade, and equity. That's usually it. A fairly, even in some large old line businesses, a fairly straightforward structure. A PE portfolio company, on the other hand, you may have first lien bonds, second lien bonds, third lien bonds. Bill actually, when he saw this in our draft of the slides, thought this was a joke where we included lien secured lenders. There has actually been at least one private placement of supposed fourth lien secured bonds in the past decade. It was crazy. And then you might have an ABL lender, and then a whole series of various tranches of debt below that, then creditors, and then one or more tiers of equity. So this vastly more complicated structure that also frequently results in companies being broken apart, and we'll look at an example later, in multiple different silos where you may have 3 or 4 different groups of companies within one business name replicate this table. And who your customer is may vary quite wildly depending on, which piece of that business you're dealing with. And ultimately, recovery may be in bankruptcy may vary wildly depending on where you are within the structure. The next slide. Usually a private equity firm is going to place itself at multiple levels of the structure. So when you had in a traditional company, say Wells Fargo act as secured lender, Wells Fargo also didn't usually happen to own, of the equity that they could appoint 3 or 4 board members. They usually were just the secured lender. Now you have entities that, within, it may be multiple funds within the same family, but you've got entities that are dealing with these businesses and saying, okay, we're going to be the first lien lender. We're also going to own half of the second lien debt. We're also going to be a participant in the ABL. We're going to hold some mezzanine bonds. And by the way, we also own 47% of the equity. So you're now dealing with a customer as sort of this dominant controlling force behind it that's all over the capital structure. And that can have a very significant impact on what happens if that company eventually becomes insolvent. We've got a few examples of recent Chapter 11 filings. We focused on retailers just because that's been a pretty dominant sector, Chapter 11 filings in the past 3 or 4 years. But all of these names are going to be very recognizable to all of you. We'll take a very quick look at Toys R Us, and then we'll move on. So Toys R Us filed in September of last year. Toys R Us had an amazingly complicated entity structure. I actually happen to have the organizational chart hanging on the wall. It's just amazing. Bain, KKR, and Vornado got together. They did a $6 billion take private back in 2006, and they immediately took the company and they broke it into pieces. So you had one chunk of entities that owned the real estate, one chunk of entities that operated the U.S. business, one chunk of entities that operated the Asia business, and you may be a supplier to Toys R Us writ large. Ultimately, you could be dealing, depending on which entities you were selling into, with 3 or 4 totally different entities scattered across the globe with totally different capital structures, totally different management, and ultimately a totally different outcome in Chapter 11.
And I guess one of the questions for Bill is, we talked about all these hedge fund portfolio companies and their financial distress. It should come to a surprise that these companies are filing Chapter 11. And, what are some of the warning signs? And what is CreditRiskMonitor plays an incredibly valuable role in identifying them very early on. Bill.
Well, thanks, Bruce. And it is my part in this presentation to talk about how you would know which of your customers or vendors are in severe financial stress and might lead to a bankruptcy. So since most of you are already subscribers, this should just be a reminder for you, but we'll go over some examples here. We're going to look at Toys R Us, Gymboree, and Claire's stores, just those 3 in the interest of time. The FRISC score is timely. It's able to warn you of bankruptcy risk. It helps you stay ahead of financial trouble at your customers and vendors. So looking at the screen, you can see in the bottom row, you can see Toys R Us, and it's been at a 1. It was at a 1 for more than a year prior to bankruptcy. Those are the dates that we're looking at. They ultimately filed for bankruptcy on September 19th of last year. So as you see in the table on the right, as the percentage of risk of bankruptcy varies at each risk category, 96% of public companies that eventually go bankrupt enter the red zone prior to filing. That's way better than most scoring models. And a FRISC score of 5 or less is an important warning sign. Probably at a 4 or below, you should take some action to mitigate your risk. 1 is big worry. So if a company's not already in your portfolio, you can look it up. The FRISC score is the best and easiest method available to monitor public company bankruptcy risk. And it's important to note that payment performance, which is captured on this slide in the Days Beyond Terms Index, or DBT Index, this index is a misleading indicator of financial stress for companies with access to capital markets, because we find over and over again public companies and large companies pay on time right up until their bankruptcy filing, and you can see that here with Toys R Us. The DBT does tell us valuable information. They were paying their bills on time, and of course we all want to know that. But the FRISC score told us that Toys R Us was in terrible shape. A look at the Frisk score relative to the broader retail specialty industry would raise an additional red flag, signaling heightened risk relative to peers. I should say that in the Toys R Us case, our new crowdsourcing signal really lit up in 2017. It showed the concern of credit managers and procurement professionals using our website. And ultimately, according to news articles quoting TRU's leadership, the company lost the support of its vendors. It was forced to file for bankruptcy because it couldn't replace $1 billion or so in trade credit it had counted on just before Christmas and pay for everything in cash. So sourcing has enhanced the accuracy and timeliness of the Frisk score since it was added to our scoring model in 2016. To do this, we take anonymized aggregated data which is the clicks of subscribers on our website, and analyze the pattern in this usage by thousands of CreditRiskMonitor subscribers. We think our crowdsourcing works so well as a signal because of who our crowd of subscribers are. These are real pros at important companies, including many of you on the phone today. You could think of it as a giant trade credit user group, 100% automatic, requiring no extra effort by the users. Financial professionals for more than 35% of Fortune 1000, by grading, crowdsourcing, stock market sentiment, credit agency ratings, and financial information, the Frisk score now offers 6% accuracy for identifying companies in financial distress. You could look at the Frisk Stress Index and see the trend of risk in this industry globally. Here we're looking at SIC code 5945, hobby, toy, and game shops. It's increased about 300% since 2007. And I think the point here is that due to competition, we in a weakening industry are vulnerable. Warned by the score, you and your colleagues need confirmation. One thing to look at is a peer analysis of financial ratios, which is shown here. And all I can say quickly is just look at all that red. Toys R Us, that puts them in the bottom quartile, and Toys R Us demonstrated bottom quartile rankings in key financial ratios versus specialty industry peers. Filed. Here, just look at all that debt. Look at the tangible net worth. Deep negative. Terrible sign. And finally, and last I should say, but not least, we're known for our news feed, which is selected based on your own personal portfolio of companies and the financial relevance of the news stories. So I'm showing here just a selection of news stories about Toys R Us, which was all over the news, but these items are hard to misinterpret. Layoffs and downgrades are seriously bad news. Next, let's look at Gymboree. The company filed for bankruptcy in June of 2017, on the 8th of June. The first score of 1 had been warning of severe financial stress for more than a year. We also issued a special high-risk report at the very beginning of May as conditions there continued to deteriorate. And again, our crowdsourcing was very important. It was an integral signal pushing the Frisk score to a 1 in this case. You can see down at the bottom of this slide that good payments leading the signal. Don't be fooled by scores that are largely based on payment data when you're looking at the large firms, and don't be fooled by how they're paying you, which is part and parcel of the same thing. It's old school to look at financial ratios and trends, but we really recommend it. The kind of cash ratio shown here usually means that the company is totally reliant on the kindness of its bankers. And we saw plenty of bad news about Gymboree, too. This is just a selection. Finally, Claire's stores. Same scary sequence of Frisk 1 scores leading up to the failure. I don't want to give you the impression that only companies with a Frisk 1 go bankrupt. That's not correct. However, 50% of failures are at risk one in the months prior to filing. I'll say that again. 50% of failures are at a risk one in the months prior to filing. So the bottom line from our perspective at CreditRiskMonitor is that it's actually not that hard to know which of the companies interested in are at risk. So Bruce, over to you. What changes have you seen in Chapter 11 due to the rise of private equity and hedge funds, and what are the implications?
I'll tell you, this is what Chapter 11 today is not the Chapter 11 of my mother, or for that matter, Chapter 11 when I started practicing. When I started practicing in 1982, the norm in Chapter 11 was a restructure, and we're talking about for all size companies, including middle market companies. Not unusual for a company to file a Chapter 11, be given 9 months to a year to fix the business, exit unprofitable lines, determine what contracts are unprofitable and reject those contracts, renegotiate their collective bargaining agreements out of unprofitable leases, and have business run for a good year as restructured, and negotiate a plan with their unsecured creditors and manage Chapter 11. That's the norm. When I started practicing in 1981, that is the exception today. The traditional Chapter 11s you can count on one hand. Most Chapter 11s have been transformed into quickie 11s, and a lot of the quickiness of 11s is a function of the motivation in hedge fund bankruptcies to the hedge funds and private equity funds' desire to get out quickly, not have an expensive Chapter 11 process or a process that's too intrusive in terms of asserting claims and trying to seek recoveries from them, which unsecured creditors want to see happen, and seeing an increased frequency of prepackaged and prearranged Chapter 11 plans. So if there is a continuation of the company, it's through a quick Chapter 11 plan process. You're also seeing, really as the norm, sales in Chapter 11 cases. When I started practicing, those were the exceptions. Now they're pretty much the norm. Let's go to the next screen. The symptom of the private equity hedge fund push and into speedier Chapter 11s is the cases are moving too quickly, and you're not necessarily seeing a fix of the company, and you're seeing serial repeat Chapter 11s, where the tendency is to focus on structuring the balance sheet, either converting debt equity or use Chapter 11 as a sale process to allow the equity to buy the company, either through the use of their secured debt in terms of credit bidding or in terms of putting in new funds, but using the 11 to buy the company and essentially continue the business as is. That's not necessarily fixing the business. You don't have the operational fixes that you need to have to fix the business, and so you have a risk that whatever comes out of Chapter 11, whether it's through a sale or whether it's through a prepackaged or a prearranged plan, which we'll talk about, the companies continue to have losses, and it plants the seeds of repeat Chapter 11. So you hear about Chapter 22, 33s, even 44s. We've even been involved in a 55, and what that means is you could have multiple instances of losses on your part, and my mother once said, shame on me, if it happens once. It's worse if it happens twice, and I didn't get that right, but so be it. Meanwhile, the speed 11s also have a disadvantage for you all as unsecured creditors, because since the case goes faster, you need to respond faster in order to make sure your interests are protected. And this is why a creditors committee has such a major role in Chapter 11 cases, because each of you individually just can't afford, given the amount of your claim and given the amount that you have at stake, to really, beat up on a case and figure out, are there recoveries, is there recovery potential, is the exit strategy that's being used right, what can we do to assure that whoever is coming out of Chapter 11 is reasonably healthy. A creditors committee fills in the holes and can really perform that role. The next screen. A lot of this Andrew already covered. You have private equity funds all over the capital structure. They could be holders of first, second, and third lien debt. Again, their motivation is to be less patient. They don't necessarily care about a customer. They just care about getting as much of their initial investment out of the company and squeezing as much profit out of the company as possible, which, by the way, could lay the seeds of a future failure of the company and also lay the foundations for claims that can be asserted by creditors committee to recover some of those dividend and other transfers to these folks prior to the bankruptcy case. Their focus is to limit their downside and put themselves in the capital structure, position themselves such they can take the company out of Chapter 11 either through a debt for equity restructuring, through a plan process, a quickie, again, prepackaged or prearranged plan, or through a Chapter 11 sale. Again, they pour the longer traditional Chapter 11 process. The problem is that's the process where the company can be fixed, and their focus is not necessarily on fixing. Their focus is also on a lot more pre-Chapter 11, pre-bankruptcy planning and negotiations. Again, the importance of CreditRiskMonitor's product is they give you the warnings because no bankruptcy should be a surprise, particularly the larger companies. And again, the increased tendency of loan to own, where if the equity holders are also in the secured tranche, they use their secured debt as an opportunity to bid, for the company. And sometimes you may have an equity funds buying secured debt, and surprise, surprise, they're going to buy it at a substantial discount and then try to credit bid the whole debt to buy the company. I couldn't resist talking about Toys R Us because they did not run through this normal, necessarily speedy process. When they filed Chapter 11 back in the fall of 2017, that was supposed to be a traditional Chapter 11, in contrast to many Chapter 11s, which we call free fall, where there's no prepackaged plan, no prearranged plan, no prearranged sale. A company files 11 in the hopes of reorganization, only to find that a few months later that they're not viable and liquidation becomes a prospect. You see a lot of that in the retail sphere. Toys R Us was supposed to be different. They got a Chapter 11 financing facility that was allegedly covenant-light. A lot of unsecured creditors thought, at least at the time. It turned out there was one major covenant. The debtor had to operate according to its budget, and what turned out to be the case was that they were missing their budget, and that laid the seeds for defaults in the first quarter of 2018. And when they announced in March 2018 that they were stopping paying the administrative claims and that they were liquidating, nobody was more shocked than the trade credit community, where you had almost $500 million plus of unpaid administrative claims, which have a real risk of not being paid in full in the Chapter 11, where these administrative claims, and again, the risk of extending credit, the horror story is showing up in Toys R Us, where creditors who extended credit have not been paid. There has been a recent settlement where approximately $160 million or so is being set aside to pay these administrative claims. That's going to be a fraction, not payment in full. And the only hope for additional recoveries will be claims that are retained by the creditors committee in a creditor trust if they come out of Chapter 11 through a plan to assert director and officer claims and other claims that could be asserted by a committee to increase recoveries. So Toys R Us was supposed to be a traditional type Chapter 11, where there was a filing in the fall of 2017 and hoped to exit in 2018, ended up being one of the worst retail Chapter 11s in history. Andrew, why don't you give a little more flesh on the bone for prepackaged and prearranged Chapter 11 cases?
Sure. So a couple of the strategies, other than a 363 sale, that we see private equity firms using more and more frequently when their portfolio companies go into Chapter 11 to expedite the process of getting them out of Chapter 11 are prepackaged Chapter 11 cases, and then pre-negotiated, prearranged cases, which are probably more common. Prepack files Chapter 11, but before it files, it has gone out, it has prepared a plan, it has prepared a disclosure statement, and has solicited votes on the plan from whatever classes of creditors needs to confirm the plan. And it shows up on day one and says, okay, Judge, we're here, we're in Chapter 11. By the way, we've got in, here it is. We'd like to have a hearing in, we saw one, I guess, a year ago that went, I think it was 2 turnaround from filing to confirmation of a plan. We've seen others that run, 2 weeks to a month, but very, very, very short turnaround. So the debt gets into Chapter 11, even cramming the plan down over unsecured creditors who are not getting paid in full. It has done all the work that it needs to do in advance to make it happen. And there's basically no runway for anybody to get an object. There's very little time for anyone to upset the apple cart, to upset the process. That being said, in a lot of prepacks, in a true prepack that's actually going to go through on that kind of time frame, unsecured are frequently paid in full. Which is a great thing for you all as trade creditors, because the bankruptcy basically has no impact on you. That's not always the case, though, and there can sometimes be, provisions embedded into a Chapter 11 plan that's a pre-PAC that can be harmful for you in the future. For instance, releases of other claims against affiliates and parents and stuff like that. So pre-PACs can be good. They can also be, actually devil's disguise. But long story short, a pre-packaged case is going to move very, very quickly. So on the next screen, we'll look at a couple of the disadvantages. One major disadvantage is, as Bruce mentioned a couple times, a major focus in Chapter 11 now is not on doing that traditional organizational, operational restructuring, where business really drills down on what the problems are that brought it into bankruptcy and how to fix them. In a pre-PAC, it's usually just, well, we've got $400 million of secured debt today. Tomorrow we're going to have $200 million of secured debt, and our former secured lenders are going to own the equity, and everything else is status quo. What that tends to lead to is these Chapter 22, Chapter 33 serial filings, where a debtor files, goes in, rah, 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 we're going to pay our trade creditors in full, we're going to, restructure our balance sheet, we're going to come out, everything's going to be great. 6 months later, oops, didn't work, we had to file again. And typically you'll see that Chapter 22 turnaround occur fairly quickly. We've seen some in a matter of months, sometimes it's a year or two. But, especially in the retail sphere, you have debtors that rush through the process, and they don't take the time to downsize. They don't take the time to, shed underperforming assets, underperforming divisions. And they, frequently they wind up in Chapter 11 again. Take a quick look at pre-negotiated cases. On the next slide, these are cases where there's not necessarily a deal with all creditors. There's not a plan. There hasn't been voting. There's no deal in place ready to go, ready for the bankruptcy court to, effectively rubber stamp. But it will have reached a deal with some of its creditors before filing, with getting enough momentum at the time of filing that they can sort of, steamroll everybody else in the process, for lack of a better term. What you'll see in these cases is what's called a restructuring support agreement or a plan support agreement, where the debtor has reached agreement with some tranche of creditors. And again, in this particular sphere, it's usually private equity that are, in the position of lenders, in the position of equity holders, whoever the fulcrum may be. They'll reach agreement with some of those, but not everybody. Typically, you'll see, releases of claims against the parent, for instance. So Bruce mentioned a while ago that, one of the things that he might do in a Chapter 11 is go out and try and recoup funds that have been paid upstream to the parent. A lot of times, an RSA will contemplate a plan where those claims get blown away. It's a prime opportunity for a creditors committee to come in, slow the process down, and try and make things right for the sake of trade creditors. But absent slowing down to the process, again, a pre-negotiated case is generally intended to steamroll the little guy. There's never an agreement with trade creditors in the case of a pre-PAC, and usually trade creditors are sort of this EBD box in the restructuring support agreement. Next slide, and then I believe that's the last slide because we're out of time. A pre-negotiated case tends to run much longer than a pre-PAC. So a pre-PAC, we've seen some that have been in and out in a matter of days, usually in a matter of weeks or months. Some pre-negotiated cases, especially if they turn into a fight because the tranche of creditors is getting the short end of the stick, they can go on much longer. We've seen some go on for months and years. Caesars, for instance, Caesars filed with a sort of a pre-negotiated deal in place, and the case stretched on for 2 years. There was a huge fight among the capital structure. So although some of these strategies are used to try and force companies through bankruptcy very quickly, the process can be slowed down. I think the best piece of information we can leave you with is, if you're in the position of having a customer that files and, is a pre-negotiated case, there's an RSA in place. If you're one of the biggest creditors, try to get a committee, get a voice. Thank you.
Good. So,
well, guys, thank you very much. I think it's very interesting. We have a few questions that have come in. I hope the audience will send us more so that we can answer them now or later in the week. Our first question asks whether perhaps Jim Reed didn't poll their suppliers, and thank you for that question. I don't know the answer to the question, and I don't know if you do either, Bruce. We don't usually find ourselves with that sort of information in hand to know what sort of deal might have been made between a company and all of its various creditors after a Chapter 11 filing. I can say that we've looked at the press releases that the company did, and if you read them carefully, what they said was they were making all of their important trade creditors whole.
But Gymboree has exited Chapter 11.
No, they now exited, yes.
Right, through a plan. Right. And I don't recall, Andrew, off the top of my head, what distribution was to unsecured creditors. And when you say the debtor can deals, there are some plans that provide that the critical suppliers are either paid in full, or if they have what's called executory contracts, those contracts are assumed if the debtor is coming out of Chapter 11 through a plan, or signed if the debtor is selling to a third party. And one of the requirements for assumption or assignment of a contract is that creditor has to be paid in full on its claim. But whether it's a sale process or a plan process, the debtor could provide in its plan, I don't recall what Gymboree provided, for disparate distributions depending on the importance of the creditors. In a prepackaged plan, usually it's 100% to trade. In a pre-negotiated type case, and I don't recall off the top of my head if Gymboree was a pre-negotiated, they can provide for anything from nothing or very little, to a significant distribution. And again, it could be based on the importance of the trade supplier. But again, all this is a function of what the Chapter 11 plan says. Let's also not lose sight of the fact that if you are a provider of goods, you have a priority claim for goods delivered within 20 days of bankruptcy. This is probably the biggest change as a result of the 2005 amendments and the most positive change for trade creditors that I've seen in my almost 40 years of practice. And these claims have to be paid in full as the cost of exiting Chapter 11 through a plan. They are administrative claims. They must be paid in full. These claims for goods delivered within 20 days of bankruptcy have a lot more value than the balance of your claim. Anything you can think of? Anything else?
So, Bruce, right along the lines of what you were just discussing, we had a question come in to ask you to address for a moment preference risk and the 90-day clawback and ways to mitigate it.
Okay, good. Wow, again, really, there's my fun. And in all these cases, by the way, one thing to think about, so Bill, that was a good question. You check the plan, and you should check what a creditors committee is doing, because many committees, especially committees we represent, try through the plan process to either waive preference claims or through the sale process to have the buyer buy the preference claims and then agree not to pursue them. So in many cases, Gander Mountain was a perfect example. We represented the committee, and as a cost or as a condition of the sale, we required that the buyer agree not to buy the preference claims and not pursue them. But and by the way, in Toys R Us, I understand that from the settlement agreement, preference claims are not going to be pursued. The trade, that's a very, very big deal, because that was one of the major concerns that I had. That if you are exposed to preference risk and the debtor is going to be exiting Chapter 11 with the ability to pursue those claims, preference claim is a payment with 90 days of the bankruptcy filing that was made from assets of the debtor from their bank account. Usually it's a check. The 90-day clawback period, all payments within 90 days are subject to this risk. Payment had to be made when the debtor was insolvent, which is presumed in the 90-day period. That's a balance sheet. Liabilities more than assets, and it is presumed. And that allows the creditor to get more than they would get in a liquidation, meaning that unless there's 100 cents for creditors or the creditor is fully secured, it's collateral, it's going to have the risk. Not every 90-day payment is recoverable, and that's the key. There are defenses that reduces preference exposure, and the defenses are based on the fact that while as preference, if you got $1 within 90 days and somebody else didn't, the theory is you got to give the $1 back, everybody shares it. But if you got $1 and then after you got the $1, you provided a trade credit, you get something back. That's called new value, and to the extent that you extended credit after you got payment, that credit that was extended is a dollar for dollar reduction. That's the new value defense to preference exposure. And that defense could cover you, particularly if a court allows the new value to be paid, where you're extending credit on very short terms, and you're getting paid, you're continuing to extend credit. Some courts have a lasting value. Then there's the ordinary course of business defense, which is a very hard defense to prove. It's got a lot of litigation behind it. It's unpredictable, but it's also, it gives you a lot of leverage to reduce your exposure. And the way the ordinary course of business defense works is if you can prove the debt was incurred in the ordinary course of business of you and your customer, and that's easy. If you extend trade credit, you satisfy that requirement. You can prove the payment was the ordinary course of business of you and your customer. That's the subjective piece of the defense. Or, not and, but or, the payment was normal in your industry. And by the way, CreditRiskMonitor is a very good help in that because they have a lot of industry data that can help you with that. You know, if you can prove either or, either payment consistent with history or payment consistent with industry, you can reduce your preference exposure. We have had incredible success with this defense, as unpredictable as it is, saved our clients, I can say, over the years, tens of millions of dollars in preference exposure. You don't want to put us in the plaintiff's chair because of our knowledge, because we can recover a lot of money. We're usually on the defendant's side. But the bottom line for preference risk, long-winded answer, you have exposure in some cases. You also have a lot of defenses that should reduce your preference liability or eliminate it totally.
I have a question, I think, for Andrew, and it is in the case where a company has a complex organizational structure, how can a trade creditor best understand the actual entity they're dealing?
So that's a phenomenal question. The first step, I think, is to ask. Depending on, and obviously that's that may be easier said than done, but at the time that you're entering into some sort of customer vendor arrangement with a customer, ask which entity will be my customer. If you're signing a supply contract, for instance, the counterparty to that supply contract will be specifically named in that contract. Look at the checks when they come in. Who's the entity that's actually paying you? Look at the POs when they come in. Who's the entity that's issuing the POs? There's a lot of different ways that you can understand who the party is that you're actually dealing with. It is a privately held company. You may not be able to do a lot of independent diligence on what the capital structure looks like, what the entity structure looks like. If you're dealing with a publicly traded company, or at least a company that has some tranche of publicly traded securities, you may be able to find out from public filings, from SEC filings, for instance, what the overall structure of that business is. I think the best piece of advice I think we can give in that regard is ask, who is my customer? If you're dealing on a large scale, you're extending millions of dollars of credit, you have some leverage to ask for instance, financial statements. What financial statements of the actual entity that I'm dealing with? What financial statements of the parent? Do I need a guarantee from the parent if the parent has all the money and the parent writes the checks? Excuse me. If you're getting orders from XZ operating company to LC, you're getting checks from XYZ parent holdco LLC. You may need to ask at that point, which entity has the money, which entity has the assets. You may need, if you've got very substantial exposure and you've got leverage, you may need to ask for a parent guarantee in that instance, because you may be dealing with a business that's got sort of this bifurcated, siloed structure where the operating company doesn't really have any assets. It just goes out and incurs all the debt. It's going to vary depending upon the counterparty and depending upon the situation. But to the extent you can get independent diligence, there's sources out there as well, particularly if you're dealing with a company that's publicly traded.
Just add to that, because I like to use my Enron story. There were multiple Enron entities, and I remember all the fraudulent conveyance lawsuits where folks were doing business with Enron Corp, and they were getting paid by Enron North America. And when the bankruptcy was filed, the estate of Enron North America sued a lot of trade creditors on the grounds that they got fraudulent conveyances, and the fraudulent conveyance reach-back period in those days was a year. Now it's 2 years in bankruptcy, but it's up to 6 years, 4 to 6 years under state law. And people were shocked. I thought I was dealing with Enron. It's a payment from a different Enron entity. They're all Enron. The answer is, but if you are doing business with one affiliate and you are getting paid by another affiliate, and that affiliate that's paying you has not given you a guarantee or is not otherwise liable, the payment could be subject to disgorgement as a fraudulent conveyance in a bankruptcy case. So when I think the old credo of know my customer, I think think that goes triple ways when you're dealing with affiliated entities and complicated structures, and you do need to know your customer, because in the worst case situation, you could end up exposing yourself to substantial risk if all the house of cards fall and they all file Chapter 11 of bankruptcy.
So, Bruce, I've got a question here about forbearance agreements and what to do as a trade creditor if you are aware that there is one, and how to interpret it, and what that might have to do with our subject to today, the private equity and the hedge funds.
I got to tell you, when we talk about red flags of troubled companies, when you hear that the company has entered into a forbearance agreement with a group of its lenders, the Chapter 11 clock is ticking. A forbearance agreement is entered into when the lender is in default, but goes back to the debtor and they negotiate, the lender agreeing not to call the default, but to defer for a period of time. The problem with that is what sort of default are we talking about? If we're talking about a financial covenant and the debtor is doing horribly performance-wise, that situation isn't going to change. And if all you have is a 30-day forbearance period, that's a Band-Aid, and that's just kicking the can 30 days to an inevitable bankruptcy to come. And I like to use this forbearance as part of the story, because I had a client that was about, the client was owed by this publicly owned debtor about $3,000. We, the client, were about to cut a check for about $250,000 for a rebate that was owed back to the debtor. Incredibly, the sales department of the company told the credit department and said, we read this article about a forbearance agreement. What does that mean? And the credit department called us, and we said, we saw the forbearance was based on breaches of financial covenants. It was 30-day forbearance, and we said, don't turn over the amount that you owe the debtor. Hold it, because there's going to be bankruptcy in 30 days. That forbearance is just a Band-Aid. It's just putting off the inevitable, for whatever reason, and we could use that $250,000 to set off against what the debtor owes us. And by the way, as a result, we cut back our credit line as a result of seeing that forbearance. So forbearance agreements are red flags of an upcoming bankruptcy, because all they do is confirm that for a short period of time, the lender agrees to defer calling a default if the underlying problems are not going to go away in that 30 days. Bankruptcy is still inevitable.
So last question, because we're sort of out of time here. This presentation, our question notes was all about retail, and I think that's largely because there were so many retail bankruptcies recently. How does what we've discussed today apply to other industries? Are there any differences? No difference at all. The only difference is that retail has, seen more than their share of problems, and they've seen a spike in Chapter 11s over the years. We go through spikes in various industries. You may recall 2016 into 17, it was the energy industry that was going through their issues. At the present time, while retail is spiking, there are other industries that are having issues, like healthcare. I think mining was having a problem at a certain point. All of these issues, in terms of the warning signs of a bankruptcy to come, or the impact of private equity or hedge funds, because they invest not only in retailers, but in other companies, in other industries. The same problems are there, and you have the same red flags that you've got to look out for, and the same symptoms of where Chapter 11 is going in those industries as well as retail. So no difference. Well, wonderful. Bruce and Andrew, thank you so much for joining us today, and to the audience, really delighted that so many of you were able to attend. I hope you enjoyed and found useful today's presentation, which we'll be making available in the next couple of weeks on our website in case you want to review the notes and that sort of thing. And we thank you for allowing us to spend the morning with you. One offer that we make is that if you have any questions, feel free to email Andrew, me, or Bill. And we certainly commit to answering your questions off the clock. So let's make this a permanent dialogue, and we look forward to seeing you at an upcoming credit conference. Thanks, Bruce. Thank you. Thank you, everybody.
Thank
Have
you.
a good day.